Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be covering a beginner topic on how to get started with options trading. This is a session for those of you that are relatively new to options trading, whether you're completely brand new and you're just exploring options for the first time, or if you're just getting started and you're maybe trying out the first few strategies. What we're going to do is we're going to break down some of the basics of option contracts, what options trading is, how it differs from stock trading, and then introduce some of the basic strategies to help you understand where you should start your options education journey. So let's go ahead and get started. But before we do, what we are going to discuss here purely is for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that you'll see as example purposes during today's session. Also, I'm going to leave this page on the screen here for a couple of seconds just to make sure that everyone understands that options involve risk and are not suitable for all investors. And if you want to find out more about the characteristics of options, you can find and download the characteristics and risk of standardized options to help you better understand the nature of these contracts and how they can potentially fit on your overall portfolio. So during today's session, we have four objectives. We want to first help you understand what is an option, how do they work, what are the differences between stocks and options, why do investors trade options, and what tools and resources are available to you to help you start your journey. Okay, so let's start off by just helping everyone understand who's interested in trading options. What is an option to begin with? Now, when you first learn about options, you might find that the definition of an option contract might sound difficult to understand, and it might sound like legal jargon. And the reality is that it is. It's a contract between a buyer and a seller. And contracts, as by nature, are full of technical jargon. So what we're going to do here today is help you break down that technical jargon so that you have a better understanding of an options contract, so that you can better utilize them or decide how you want to utilize them in your portfolio. So an option is simply a contract between a buyer and a seller. And in the case of an option contract, the buyer is always going to pay a premium and can execute on the terms of the contract. And on the other side, sellers are obligated to fulfill the terms of the contract and effectively collect the premium that the buyer pays for the option. You can think of it almost like an insurance contract to some degree. You know, there's a buyer of an insurance contract and a seller of an insurance contract, and the buyer effectively of an insurance contract has the rights or the ability to execute on the terms of the contract if it is favorable to the buyer of that insurance contract, and then the seller of the insurance contract is effectively obligated to fulfill the terms of the contract if the buyer chooses to execute on the terms. Right? There are obviously terms that have to make sense for the buyer to execute, but I think that's one of the more parallels that I think many people can draw with regards to your everyday life to thinking about whether you want to be a buyer or a seller. And what's interesting about an option contract is that you can choose to be either the buyer or the seller. Unlike an insurance contract, you basically can only be a buyer. Chances are you're not selling insurance contracts. But in this particular case, with an option contract, you can be a buyer or a seller. And each contract is issued either as a call or a put. Call contracts contain the right to buy the underlying security, and put contracts contain the right to sell the underlying security. So effectively, what you're buying is the rights to either to buy a specific stock or to sell a specific stock. And we're going to look at kind of the details of that contract. Okay, so you're going to see an option contract many times will look something like this, but we're going to break that down here in 1 second to help you better understand what the terms of those contracts actually mean. So when you look at a option, there are four things that you're effectively agreeing to within the terms of the contract. Number one, you're agreeing to the quantity, the contract amount. So each contract represents a certain number of shares. A standard contract, a standard option contract, is for 100 shares of the underlying security. So whenever you buy a call option or a put option, you're effectively buying the rights to buy 100 shares of the stock or sell 100 shares of the stock. And you can trade them in multiple contracts. So you can buy 2 contracts, which would be give you the right to buy 200 contracts or to sell 200 contracts. So you can choose how many contracts you want to buy, but each contract is going to be a multiple of 100 shares per contract. That's the minimum contract size with options trading. The second thing you're going to agree to is the product. What are you agreeing to buying or selling? Are you agreeing to buying and selling Apple stock or SPY the ETF or GLD the ETF or NVIDIA the stock? So you have an underlying security. It could be a stock, it could be an ETF, it could be an index, it could be a currency, it could be a commodity. But the contract will state what what amount for what specific underlying security that you are agreeing to buying or selling. The third thing you're going to agree to is a price at which you're going to buy or sell at, and we call that the strike price. So, for example, if you are buying a call option on Apple to buy it at $200, the strike price is $200. You're basically agreeing that you have the rights to buy 100 shares of Apple stock at exactly $100 or $200 or whatever the strike price is for the contract. And then lastly, the fourth term of the contract is an expiration date. The date at which the contract ceases to exist. So effectively, once you buy or sell an option contract, that contract is valid until the expiration date, until, generally speaking, the close of business of that expiration date. So if we're looking at September 20th, then effectively that contract is good until the close on September 20th. So when you review an option contract here, what we have is one contract of ABC stock for $100 that expires on March 24th. What that means is that if, let's say, this is a call option, then this gives the buyer the right to buy ABC stock at $100 on or before March 24th for 100 shares of that underlying security of ABC stock. Okay. So like I said, an option contract many times may seem like technical legal jargon because it really is. You're basically specifying option contract terms of what what the buyer and seller is agreeing to. And once you have the terms, you have a price at which the option contract is purchased from the buyer, by the buyer rather, from the seller. Okay, so because you can either be a buyer or a seller of a call or a put, we generally refer to this particular T-chart to help you understand the 4 basic option contracts you can enter as an options trader. You can either be the buyer of a call option, which gives you the right to buy the underlying security, or you could be the buyer of a put option, which gives you the right to sell the underlying security. That is the 2 contracts that you can potentially buy. And on the other side, you can be an option seller. If, let's say, you choose to sell a call option, what happens is you are obligated to sell the underlying security. And if you're selling a put option, you're obligated to buy the underlying security. You're always effectively on the other side of the buyer versus the seller. So, for example, the buyer is the right to buy, and the seller has the obligation to sell to the buyer. And vice versa, a short put and a long put. When you're buying a put, you have the right to sell. And who are you selling to? You're selling to the seller of that put option, who has the obligation to buy from you as the seller. Okay, so those are the 4 basic option contracts that you can potentially enter. And we're not going to get into today how you can combine multiple option contracts in a single strategy to achieve various outcomes, right? Right now, we're just trying to help you better understand the basics of these 4 option contracts. Once we understand the 4 option contracts from a fundamental perspective and the foundations of it, that's when we can build on top of that and say, well, what happens if you were to buy a call option and sell a call option at the same time, maybe at different strike prices or different expiration dates? What can that help you achieve? That's for a later date. But the first step is to just help you understand these four basic option contracts. So let's talk a little bit about the differences between stocks and options, because many of you that are interested in trading options today, you may currently have some experience trading stocks. So let's kind of think about the difference between the two, right? Because there are many similarities, but also at the same time, there are many differences. So as a stock investor, your goal is effectively capital appreciation, right? You buy a stock because you believe it's going to appreciate in value. And when you own a specific stock, it gives you ownership of to collect dividends if the stock pays a dividend, and voting rights if there are any voting rights associated with that specific class of stock. And when you buy a stock, you can effectively hold on to it for as long as you would like. So you buy a stock, you can hold on to it for a few minutes, a few days, a few years, a few decades. It's up to you as far as how long you want to own the stock, and you can own it for as long as you prefer. And when you buy a stock, generally speaking, the things that are going to affect the value of that stock are the earnings from the company, and how the company manages the company and the revenues from that company. Those are generally the things that are going to influence the value of your stock, right? So if a company makes more, grows their earnings or grows their revenue, then you're going to see, generally speaking, an appreciation in the value of your stock. If the company, management, it gets more efficient or less efficient, you're going to see that reflected in the stock price. And generally speaking, as a stock investor, you're going to use a few different methods to help you understand that, right? You can look at technicals, look at the chart to help you understand price action and what the market is doing in terms of where buyers and sellers are, to help you analyze the specific or possible entry points for a stock investment, and then fundamental analysis to help you better understand kind of how the company is managing the company from a financial perspective. The thing about stock ownership is that it typically does require a fairly large capital outlay. You need to have a lot of capital to own, a significant portion of a company's um, of their equity, their stock. And stock ownership has what we call symmetrical risk profile, meaning if you own a stock and it goes up by $1, then you make $1 in capital appreciation. If the stock declines by $1, then you lose $1 of your initial investment. It's dollar for dollar. If the stock moves up by a certain amount, you know exactly how much you'll make. If it goes down by a certain amount, you know exactly how much you'll lose. So I think for a lot of investors here who are watching this session, you're probably have a pretty good understanding of kind of stock ownership. So let's now take a look at option contracts. So an option contract, uh, does not give you any ownership of the underlying company. What it does is it gives you the ability or the rights to buy or sell that specific company at a specific price sometime in the future. And you're going to have various outcomes and goals when you're trading options. Sometimes you may have a view on the stock, like you do with the stock ownership. You think the stock is going to appreciate in value, but you can also believe that the stock is going to depreciate in value, and that's really kind of where options give you some flexibility, because you can have different outcomes, right? You can have a bullish view, you can have a bearish view, you can even have a neutral view and be able to profit from it by trading options. When you're trading stocks, if you believe that a stock is not going to move by much, it's just going to trade sideways. Think something like AT&T or Verizon, right, where it doesn't really move by much, and you just think it's going to continue moving sideways. Well, you can't really make much money from those types of stocks, right? Granted, those stocks may pay a dividend, and you might own those stocks and earn dividends, but you're not going to get much capital appreciation from that stock, just from that neutral view. So one of the things that you can do with options is you can actually profit from that neutral view by selling up, by being a seller of options. And we're going to talk about some of those strategies here in a few minutes. But an option contract does not give you access to dividends or voting rights, and instruments have a limited time horizon. So from that perspective, it differs from stock ownership. However, keep in mind that the option is listed on an underlying stock. So the things that influence the price of a stock will influence the price of an option, but options also have added price influences because volatility, how much time is left between now and the expiration date of the option contract, and even interest rates will have a influence on the value of the option, right? So as the price of the stock moves up or down, it's going to affect the value of your option. As the stock gets more or less volatile, that will affect the value of your option. How much time is left between now and expiration will affect the value of your option. And lastly, interest rates. So because you have more factors that will influence the value of your option, there is an increased complexity to trading options. However, it requires less capital outlay, meaning because you're just buying an option and you're not buying the actual underlying security, you actually only put up a fraction of the capital to buy the specific option, whether that's a call or a put option. And that gives you, to some degree, leverage on the directional view. So if you think a stock is going to move significantly higher, you could buy the stock, but you could also buy the option contract. And the option contract will typically trade at a fraction of the value of the stock's price. And if the price of the stock does increase in value, the value of the call option will also increase in value, which gives you, like I said, leverage on your investment on capital. But there are trade-offs with that. There are risks with that. There are what we call asymmetrical risk profile, meaning if the trade goes in your favor, you'll see unlimited upside potential. But if the trade goes against you, you have limited risk. And that's really kind of a fundamental part of options trading that actually attracts a lot of beginners, right? Because you're thinking to yourself, okay, I can outlay a much smaller percentage of capital than buying 100 shares of the stock. Yet, if the stock goes in the direction I expect it to, I have unlimited profit potential, which is great. And if the trade doesn't go against me, or I'm sorry, if the trade goes against me, I have limited losses. I'm basically getting the best of both worlds from a leverage perspective, right? Meaning if the trade goes in my favor, I have a leverage position. I'm basically levering up my capital. And then if the trade goes against me, traditionally, if I'm leveraged, I would suffer huge losses to the downside. Here with call options, I don't. I actually have limited risk. So I'm kind of getting the best of both worlds. Now, that's what attracts a lot of investors to trading options. But I will have to say, there are some trade-offs to this asymmetrical risk profile, and we're not going to have enough time to get into those trade-offs today. And because we do have a separate session just on those. Understanding kind of the characteristics of buying an option separately in a separate webinar. But I do want to just clarify that despite the fact that that's the reason a lot of investors start taking a look at options, there are some trade-offs with that asymmetrical risk profile, which sounds very attractive. Okay. So why do traders use options in their portfolio? Generally speaking, there are three reasons that you might want to consider utilizing options in your portfolio. First and foremost, which is probably the most obvious one, which is speculation. You basically have a directional view on the underlying stock or underlying market, and you want to express that view utilizing options. It gives you a leveraged ability to express either bullish, bearish, or even neutral views on the overall markets. Or there are just a lot more views that you can express using options that you can do with stocks, right? So if you think a stock is going to get more volatile, you can profit from that. If you think a stock is going to get less volatile, you can profit from that. If you think it's bullish or bearish or neutral, you can profit from all of these. So you just have a lot more different possibilities that you can potentially profit from trading options. The second, and arguably probably the most popular one with more experienced investors, I would say, is income. Like I said, you can be a buyer of an option or you can be a seller of an option. And selling options You can think of them, a parallel that you can think of is like selling an insurance contract, right? It's a very, very popular way for investors to generate income. Selling options, selling call options, selling put options, and collecting that yield is a great way to potentially add an income stream to your portfolio. And then lastly, hedging. This usually is for investors who have a portfolio. They are concerned about downside, such as the current market condition that we find ourselves in today or over the last couple of weeks, where you are concerned that your investments could be at risk of further downside, and you want to try to protect that. You can potentially utilize options to protect a portfolio against volatility and against further downside by buying different types of option contracts that can offset some of the losses in a portfolio if markets were to crash or to decline significantly from where they are today. So those are the three general reasons that most investors utilize options in their portfolio. Um, and just to kind of help you understand like frequency, income is largely going to be probably the most frequent strategy that's traded. These are systematic strategies that you're kind of, selling options every single week or every single month to try to collect income. You're doing that all the time. Speculation is probably second most frequent, right? You have a view in the markets, you want to express that view, bullish or bearish view. You take it when those opportunities arise. And then thirdly, hedging is probably the least utilized strategy because it's not that often that you believe the markets are going to crash and you need to get some protection here. So you only use those in the instances where you feel that markets are at risk of further downside. So hopefully that helps you understand the different strategies that you might deploy and just generally speaking how frequently you might want to deploy each of these strategies in your portfolio. So let's talk a little bit about speculative trading, right? This is when you expect a sharp directional move up or down. This could be on earnings. This could be on a technical breakout to the upside or technical breakdown to the downside. There could be some kind of catalyst like a macroeconomic event coming up. Whatever it is, something is giving you a view that you think a stock's going to make a big move in one direction or another. This is where you can look at buying a call option or a put option, depending on whether you're bullish. A call option would be bullish, a put option would be bearish. And it gives you the right to either buy or sell the underlying stock through the expiration date of the option contract. Like I said, this webinar is not meant to help you understand these strategies because we actually have separate webinars to help you dive into, what a long call, long put strategy looks like, help you better understand when you might want to deploy it, what you need to be concerned, thinking about in terms of risk, and kind of what are the differences between these strategies and more advanced strategies. So we have separate webinars that actually cover those details. This is meant to be a general overview of the different strategies that you could potentially trade as an options trader, depending on your overall views of the overall market. The second strategy, like I said, is income trading. And this is, like I said, for more experienced investors, once you learn how to trade options, this is likely going to be the most consistent strategy in your portfolio because unlike speculative trading, which requires you to have a specific view on a stock at a certain time, like sometimes you just don't, you don't, it's not every day that you think Apple stock is going to move, $20 higher from where it is a month from now, right? Occasionally you might have a view that, the stock is really oversold, so you think it's going to bounce higher, or it's overbought and you think it's going to bounce lower, or earnings are coming up and you think it's going to make a big move. That's when you use a speculative strategy. But generally speaking, income generating strategies, you might be basically selling options every single week or every single month. It's a much more systematic strategy. You're kind of doing it all the time to generate incomes, similar to like a dividend paying stock. So with these types of strategies, you're basically trying to add yield to your existing portfolio using options. And this is either by selling a covered call or a covered put. Both of these strategies are bullish. Basically, you do these types of strategies on stocks that you believe in the long run will appreciate in value. And it gives you the obligation to either buy or sell the underlying stock through the contract terms in exchange for the premium. So this is really where you are. Like I said, the best parallel that I can draw is think of yourself as the insurance company. You're selling contracts, you're selling call options and put options, and someone is paying you premium to be a seller of that contract. And when you sell that contract, you're basically obligating yourself to buy or sell a specific stock at a specific price. And for those of you that maybe have some experience trading options or maybe have heard of this, there's a strategy called the wheel strategy, which is where you sell a cash secured put, you sell a put option, you continuously sell put options until you are obligated to buy the stock. Once you own the stock, you then start selling call options, which obligates you to sell the stock at a certain point sometime in the future, and you keep selling call options until the stock gets called away and you effectively sold your stock, and you basically start all over, right? You basically are generating income, purchasing stocks, holding onto those stocks, and eventually selling those stocks, hopefully at a profit, and then taking the cash from selling the stocks and rolling it back to selling more put options. So you can think of it as like trying to buy stocks. You're trying to buy low and sell high, right? And put options basically give you the option, give you the obligation to buy the stocks at a specific price, and then eventually sell the stocks at a specific price. Called the wheel strategy, and it is probably one of the most popular option strategies that allow you to generate income on your overall portfolio utilizing options. And then lastly, like I said, hedging. Hedging is something that you're going to use very infrequently, but given the market conditions that we're in right now, a timely, I would say, discussion, right? Over the last decade, there haven't been too many opportunities to look at hedging your portfolio. Obviously, the 2020 downturn in March was one specific opportunity to hedge your portfolio. We did have a sell-off towards the end of last year in the S&P 500. That was probably a second opportunity in the last 10 years. And then right now we're experiencing quite a bit of volatility. So another opportunity to potentially hedge your portfolio if you're concerned about further downside protection. So we're really talking about in the last 10 years, three real opportunities to potentially hedge your portfolio. There may be smaller ones throughout the 10 years where, whether that was the Volmageddon or, I remember there was a Christmas crash going into, I think, 2018 or 2019. That kind of got pretty severe, but bounced back, by New Year's Day. But a lot of those were pretty short-lived in terms of market sell-off. So you were really talking about a handful of opportunities in the last decade to hedge your portfolio. But when the opportunity, or rather the need arises, options give you the potential to protect your portfolio against a downside correction. And it allows you to effectively remain invested in your investments so that, number one, you can still continue to collect any dividends on the stocks that you own, and you don't have to pay a tax bill by selling your assets into cash. A put option or a hedging strategy using options effectively allows you to protect your portfolio against downside, but at the same time remain invested so that you don't, you don't trigger a tax bill, and that you can still continue to earn dividends on the stocks that you own. So those are some of the reasons why you might want to consider using an option contract to hedge your portfolio rather than simply just selling your stock and buying it back at some time later when you feel the markets have bottomed. So those are the three core, I would say, strategies that you will generally think about using. Now, what we went over is really kind of the basic strategies that you can trade, right? Because when you're speculative trading, there are a lot more strategies that you can trade than just a long call or a long put. But as a beginner, when you're just starting out and you're trying to keep things simple, those are the two strategies to think about. A cover call and cash secured put, or a cover put, are two strategies that you can use. A simple strategy that you can generate income from, and then a long put against a stock portfolio is a way that you can hedge your portfolio. So these are all simple strategies to help you get started and help you understand when you might want to deploy them in your overall portfolio. So that hopefully gives you an overview of kind of how options, how to get started with options in terms of, some of the basics, just to kind of help you understand a little bit about next steps. First of all, start with education. There's a lot of education available to you here at First Trade, starting from, options 101, options 201, and even more advanced strategies, all available to you for free at First Trade. Get engaged, start looking at the educational content that's available to you. That's going to be your first step in just understanding these strategies, understanding when to utilize them so that you can start exploring these types of strategies. The second thing is, start thinking about like what is the sentiment that you have on the overall markets and start building a process. And then start utilizing the tools that are available to you here at First Trade to help you analyze some of the ideas that you might that you might have in the overall markets. So that is the access to the options play widget available to you on First Trade. There are options screening tools that find you kind of high yielding income plays using covered calls, cash secured puts, even more advanced strategies that you have. These are all available to you at your fingertips to screen for opportunities, analyze opportunities before you execute your trades in your portfolio. And then lastly, once you kind of have explored these types of strategies, making sure that you understand what are exit strategies. So don't just think about how do I enter these trades, but really have a process down for once you're in the trades, when you are going to exit these trades. Now, these are things that we all cover in our education that's available to you here at First Trade. So I highly encourage for those of you that are looking for kind of what's your next step to start exploring some of that education that's going to help you understand your next steps for trading. So with that covers what I wanted to share with you here today. Hopefully this gives you a good first step in terms of getting started with options trading. What we have is a Q&A button here at the bottom of your Zoom window. So if you have any questions, please type your questions into the Q&A window. I'll try to answer as many questions as I have time for today before I have to sign off. There is a Q&A window that should be at the bottom of your screen. You should be able to click on that and type any questions you might have. Yes, this session is recorded, and you'll be able to find that recording on the First Trade website. When will the recording be available? That's a question that I'm sorry that you're going to have to ask your First Trade representative on. Usually it doesn't take more than a couple of days, but you can certainly get a copy of the recording from the First Trade team. Is there a demo area in First Trade? So, there are a lot of tools available to you at First Trade. There are no demo accounts if that's what you're asking for, but there are a lot of, the options play tool that's available to you within First Trade allows you to kind of set up trades. Or stage trades and analyze the trades before you actually execute them. And those are all available to you for free in your First Trade account. And just to show you kind of how to access that, when you log into your First Trade account, you're going to see an options wizard button here at the lower left-hand corner. That's a great place to start. That's going to launch the options play platform. And the options play platform is designed to help you get started with options trading. So regardless of what stocks that you're interested in, so let's say for today, let's say, for example, you're interested in, I'll pull up something like NVIDIA, for example. Let's say you think that the market sell-off is overdone, it's time to be a buyer in the markets. Well, what you can do is you can select what your views are in the market. So you can say I'm bullish on NVIDIA or I'm bearish on NVIDIA. And what the platform does is it helps you compare strategies side by side. So let's just say, for example, you're still bearish on the overall market. You think stocks are going to continue moving lower here. So here's an opportunity to basically look at 3 bearish strategies on NVIDIA. You can short sell 100 shares of the stock. You can buy a put option, or you can buy a more complicated strategy called a vertical spread. And the goal here of this platform is to present to you three starting points, three strategies that kind of go from beginner to advanced, to help you understand kind of the different ways that you can express a bearish view in the markets utilizing options. And it gives you the tools to help you compare the strategies side by side. So let's say you believe NVIDIA is going to get back down to, I don't know, $80. You can type that into your P&L simulator, and you'll be able to see what your profit potential on these strategies are, compare it side by side. It'll tell you how much each trade costs, what your profit potential is, and then if you click on it, you can even see things like max risk, max reward, your probability of profit, your break-even price. All of this information is available to you here on your Options Play platform that's free of charge for first trade customers. This is the best way, in my opinion, to help you learn and get started with your trading. You just have to type in a symbol and click on either bullish or bearish. And if you're ready to trade income strategies, we also have automated strategies for cover calls and cash secured puts. We also have trade ideas, both from a technical idea perspective, which is looking at the underlying security, or we have cover call, credit spreads, and short put opportunities that are all available to you here on the Options Play platform. So if you're trying to figure out where can I generate the most income selling cover calls or selling cash secured puts, this platform basically helps you rank, what stocks will generate the most amount of yield selling cover calls or selling cash secured puts, and ranks it for you so you have the highest yielding opportunities at the top of your screen. It'd be useful to have practical examples. So today's session was not meant to go through any practical examples. All of the subsequent sessions that we'll be doing going forward will have all practical examples, but those are when we actually get into specific strategies. We'll go through real symbols and real examples when we kind of break down the actual strategies themselves. So that's coming. Please, for those of you that are interested in doing that, I hope that you'll be able to join us for future sessions where we do go through real examples of different strategies that we learn. So are there any educational videos for beginners? Yes, there are a lot of, so if you go to education, you go to options, you have a lot of, content that's available to you through the Options Industry Council. But also if you go to the First Trade homepage, firsttrade.com, and you go to resources and you go to Options Wizard, you'll see we have quite a few trading courses. We have a complete trading course, which will go through a beginner, intermediate, advanced strategies. They're all available to you here on firsttrade.com. I'll post this link into the chat window as well. When I set up my account as approved for level 2, I want to do spread, so I need level 3. How do I go about getting that approved? Please call your First Trade representative and speak to them. That's going to be something that you're going to have to discuss with your First Trade representative. Is there a list of stocks that too easier to start exercising options since having 100 shares could be expensive? So great question. Eugene's asking, how can I find stocks that are less expensive, right? So when you use the Options Play Wizard, or if you look at, we have options trade ideas that are available to you, you can sort them based on the strike price or even the price of the stock, right? So, you can basically say, okay, I'm only looking at credit spreads or cover calls or cash secured puts, of low price stocks. You can do that here by saying, okay, let me look at only selling put options on low price stocks like Snapchat, so this is one way that you can basically find opportunities that are less expensive or where the option contracts are relatively inexpensive. Can I buy puts to hedge my portfolio using my Roth IRA account? That's a question for your First Trade rep as far as what type of strategies are allowed and what types of accounts. Generally speaking, if you're approved for options trading, then yes, you will be able to do that. Does cash secured, because cash covered calls require the amount in your account to buy 100 shares? Yes. So covered calls and cash secured puts require you to have the cash to own 100 shares of the stock or to own 100 shares of the stock in order for you to trade these types of strategies. Is the premium good for one contract or shared numbers of the contract? So I think, Carol, your question is, so for example, if the premium in this particular case is $4, let's look at the Snapchat trade, right? So the mid price here is 42 cents. So what that means is that you're going to collect in this particular case $42 in income by selling this cash secured put, because each contract represents 100 shares. 42 cents is a per share number. So you have to multiply this number by 100, which gives you $42. So in this particular case, if you were to sell the Snapchat short put, you would earn $42 worth of income. Hopefully that answered your question, Carol. Any other questions for today? If there are no other questions, I just want to thank everyone for taking your time today. Like I said, this is just an introduction class. We do this every other Wednesday at 12 p.m. So if you're just starting out, please come back. During our next session, we have sessions planned throughout the rest of the year where we will kind of cover everything from basics to more advanced strategies. We'll even look at earnings season. We'll look at a lot of different things as to how you can utilize options to navigate the markets. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on our next Tuesday market outlook session. So I run two sessions with First Trade. Once a week on Tuesday mornings, we go over the overall markets. I walk you through kind of a macro outlook. I walk you through the asset classes. I walk you through the sectors and some trade ideas for the week. And then every other Wednesday, we're here to do education to help you better understand kind of best practices for trading options. So a lot of different resources are available to you here at First Trade to help you navigate the overall markets. Thank you so much and have a great trading day.